Hi, everyone. Thank you so much for being here. I am Marche, the webinar director here at Advice Chaser. We're so glad you've joined us. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box, and presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's event to answer your question. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's speaker. Ethan T. Brown is a partner and portfolio manager at Cox Capital Management. He specializes in portfolio optimization techniques and quantitative strategies. His primary responsibilities include equity and fixed income research, portfolio management, and trading. He has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. He currently runs the internship program at Cox Capital Management, and he is a former national champion triathlete and 2012 Olympic trials qualifier. There. He sits on the board of directors for the Drake Academy of Excellence. And Ethan, I'm so pleased to have you here. And I'm going to go ahead and turn the time over to you to talk about this very important topic.
Well, thank you so much, Marche, and thank you everybody for tuning in today. I hope that you learn a lot. I'll do my best to share my experience, and I think what we have for you today is going to be a mix of what we consider best practices, but then, like I said, we're going to try to add in some personal experience that can kind of make these concepts come more to life a little bit. So I believe we have an agenda, and I'll start out just by briefly introducing my firm and just talk about why we think that we're experts in this area. And then we're really going to touch on three main points today related to portfolio governance. Now, the first is going to be how do we build an investment policy statement. An IPS, as an abbreviation, is a roadmap for how your foundation's money should be managed. We'll talk about how to form an investment committee, and then we'll cover what I consider to be kind of a hot topic lately, which is ESG issues related to the portfolio. So these are environmental, social, and governance factors, and they're becoming a bigger and bigger area of impact, especially in the nonprofit space. So we'll give you some thoughts there and some kind of a framework for how you should be thinking about that. And of course, we'll wrap it up with a little conclusion and any questions as well. So just real quick about Cox Capital. It was founded by my partner and mentor, Bill, in 1997. And so since 2000, he's really been working, part of the business has been managing money for nonprofits. So it's been over 20 years at this point that we've been operating in this area. And I would say that over the past 5 years, it's been not just managing money, which is our expertise, but it's been more about consultative and, I guess, giving the foundations we work with, advice on how to build an investment policy statement, some advice on forming an investment committee, and I think that's been a real value add for folks. And so we work with anywhere from what I would call small to mid-sized clients. I think our nonprofits range from investment assets of about 500,000 to about 20 or 30 million in assets. And just a disclaimer, we're not here to sell anything. We really just want to try to provide a good educational overview in a few areas. I think we've got some good expertise to share, so we're excited to get into it. So at a real high level, what is portfolio governance? And it can be a lot of different things, but the way that we think about it is having in place either a structure or a framework that helps you understand and monitor your portfolio, make sure that any fees being charged are reasonable. And the big one that's become more of a factor lately is making sure that your portfolio is working for you, not just in a financial sense, but in terms of kind of aligning with your organization's mission. So that's becoming more and more important to more people nowadays. It's also a framework for maintaining a diversified portfolio. I don't know what your personal level of investment experience is, but I'm sure you've heard, diversification is the number one thing when it comes to investing, and I'm not going to tell you anything otherwise. So there's framework on how you maintain diversification, and like I said, it's kind of a two-pronged approach when it comes to a nonprofit's financial objectives and their kind of social mission as well. And so both of those are encompassed within portfolio governance. So the first area that we're going to cover today is going to be building an investment policy statement. And so, like I said, the IPS is going to be a roadmap of how your money is invested in terms of the asset allocation, what's your expected return, what's the time horizon, what's the level of risk, if there is any sort of liquidity needs from the portfolio, that should all be spelled out in an IPS. And the good thing about having something like this is that it really aligns the interests and in the understanding of both parties. So an investment manager has a clear view of how they should be investing the money, and the organization has a clear view of their expectations for this. And just a personal story from this is, when it comes to having an investment portfolio, your asset allocation is going to be really the main driver of returns. So basically, what proportion of stocks relative to bonds do you have in a portfolio? We got a call a couple of years ago from somebody that was looking to switch investment advisors, and they had said that I think that the year was 2017, and the S&P 500 was up like 20% or something like that. And they had an investment manager that was very, very nervous about the markets, and they kept all their assets in cash and gold for the whole year. So it was an enormous opportunity cost, and they lost out on a lot of financial gain in that year. If they had had an investment policy statement in place, they may have had a target range saying that you need to maintain between 50 and 70% equity exposure in the portfolio, and it protects you from disasters like this, where something is just kind of so off the mark, and it kind of works against you. So that's why you want to have a strong IPS in place. And again, it contains all the parameters around risk tolerance, your return expectations, what the asset allocation is. It should specify how performance is measured. So it's very common in the financial industry to have a benchmark to compare against your portfolio performance. So if you have, for example, a portfolio of large U.S. companies, you might want a benchmark of, say, the S&P 500, which are the largest 500 companies in the U.S. So you can kind of compare how you're doing to that. And if there's any dispersions between your portfolio and that benchmark, you can kind of ask why and kind of delve into that. And again, when it comes to risk tolerance, time horizon is a really, really big factor in terms of how much risk you can take. Because certainly if you have money that you need for a project next year, you don't want to be exposing it to market risk. And then finally, any ESG requirements are going to be spelled out in the IPS as well. And sometimes fees are in there too, but mainly those would be in an advisory agreement, but they can also outline the fee structure there too.
Oh, we had a question come in. So what about the creation of this document? Is it something that the board of directors or a committee puts together, or is this something that you work with an advisor with? Can you tell me a little bit about that process?
Sure. Yeah, this would be typically something that an investment committee or board of directors would put together. And I would say you'd want to work with a financial professional that has the know-how to provide some consultative guidance in this area, because at the end of the day, they're the experts. So I think that they should have input. But a lot of the kind of areas that I highlight here, these are the main areas that'll be spelled out in an IPS. And again, I think it is the responsibility of the board of directors to have this in place. So like I alluded to earlier, when it comes to picking an investment strategy, your equity exposure in the portfolio is going to really be the determining factor in how much risk there is in the portfolio. So to back up for a second, and I don't know people's familiarity with investments, but I'm just going to keep things very general and broad. So equities or stocks are risky. They're very volatile. They can be up or down a lot every day, but over time they should produce pretty good returns. Whereas bonds are much less risky. They're more stable. Not to say you can't lose money in that area, but in general, it's considered a lower risk investment. And so when you're thinking about a portfolio, the more equity in the portfolio, the more risk there's going to be. And I would say that for nonprofits, there's kind of a cliche nonprofit asset allocation, and this would be the 60-40 portfolio. So if you're familiar with this term, this would be 60% equity exposure, then 40% fixed income. And so this allocation is chosen for a lot of nonprofits because it is more on the moderate to conservative side, and it allows for growth, but it does have a pretty big fixed income allocation or bond allocation, so it can provide for some downside risk as well. So kind of getting on the factors of how do you determine whether or not you can take more risk in your portfolio. I would say that if you have a new nonprofit or foundation that's just getting established, maybe you have a portfolio, but you also have really unstable cash flows. You don't have a consistent funding strategy at this point. You're not sure if you're going to get grants that you may have gotten, you're going to get them again the following year. If there's that uncertainty there, you probably want to err more on the side of caution, and you'd have a much bigger fixed income exposure there. Again, if there's ongoing need for distributions, like many nonprofits or 501c3s, you need to distribute 5% of your assets in order to maintain your 501c3 status. So in that case, you'd want a decent amount of liquidity and kind of a lower risk tolerance in your portfolio at the end of the day, because you don't want to do anything that could jeopardize that. If you have a large part or a large project coming up and you know that your portfolio is going to be the main source of funding for that project, that would be another reason to scale back on the equity allocation. On the other side of it, if you're with a well-established foundation, you have a variety of different sources of income between donations, grants, maybe you have operational activities that generate cash flow. There's lots of money going into the portfolio. Those are all factors that would say, you have a long time horizon. You're not going to need to touch the money for a while, so you could have a higher equity exposure. I think one of the clients we work with, is a cemetery, and their time horizon when we did this process for them was literally 100 years. Their just portfolio at some point is going to need to maintain just the land and the groundskeeping of the cemetery. But it's a very, very small percentage that they would actually need to pay out relative to the size of the portfolio. So given those circumstances, not a whole lot of cash flow needs, super long time horizon, they could take on a lot of risk, because if things go south the wrong way, they have a lot of time to wait to recover that value. And here's a quick example. This is a slide we do in a lot of our nonprofit presentations. It's an IPS checklist, and it doesn't encompass the whole IPS, but it's kind of just the main areas. So we would just be mapping out what's the long-term performance objective, has that been met? When it comes to diversification and level of risk, are we kind of in bounds based on what's set out in the IPS? And down below here, you can see that there's kind of an asset allocation target. And so are we within the ranges and all those different areas? And so this is just something we kind of do on an ongoing basis to make sure that we're within the parameters of the IPS. And again, so we're kind of meeting the objectives of whoever we're managing money for. And so when it comes to governance and IPSs and investment committees, at the end of the day, it's about avoiding disaster. With investing, if you take on more risk and you can generate a little bit higher return, that's great. But if you take on more risk and that risk leads to a loss of value that you can't get back, then you've done permanent damage. So that's why, just as a high-level philosophy, and other people may differ, but at least at my firm, we kind of err on the side of conservatism. That's kind of just our nature, and that's, I think, more appropriate for folks operating in the nonprofit space. So just what you're looking at here, so this is a chart of the S&P 500. So this is like the main market index in the U.S., and this runs through from 2006 to 2013. So you can see that in 2007, the market kind of peaked before we hit the financial crisis in 2008. And so if you had a portfolio that was exposed to too much risk, the worst possible thing that you could ever do is pull out money in a market trough. And the reason is simply because once you pull it out, the value is permanently destroyed and you can't get that capital back. And the asset allocation stuff is so important because if you need to withdraw money in a time like this, it could be because if we're in a financial crisis, your funding sources may have dried up, your donations may not be as robust, you may have a higher need for cash in times of kind of severe economic stress. So it's kind of ironic in a bad way that when the market's down, your cash needs might be greater. But this is why kind of using a balanced approach, having some cash, some fixed income, some equity exposure in a mix that kind of suits your long-term goals is really critical. You want to avoid this disaster scenario at all costs.
We had a question come in about that kind of specific thing, and everyone probably remembers when COVID first hit. The question was, having that fixed kind of buffer there, it's kind of an emergency type of reserves for that kind of emergency, about how many months or years or what kind of horizon should people plan to kind of keep in reserves?
Sure. Yeah. Well, I mean, I can answer that from a financial planning perspective. If you have a variety of sources of income at your particular nonprofit, the rule of thumb in the financial planning world is typically keeping about maybe 3 to 6 months worth of operating expenses kind of in liquid cash. And that's something that I wouldn't even have in an investment portfolio. So, I would have that emergency fund kind of set aside. There would be some cash and liquidity in the portfolio, but I wouldn't dip into that unless you've exhausted your emergency fund. But typically that 3 to 6 months of an operating budget, that's kind of the range, that we see most people use. Okay, so the second topic is related to investment committees. So an investment committee is kind of almost like a subgroup of the board of directors, whose job really is to kind of monitor and do the administration related to the portfolio or the investment assets. And members of an investment committee have a fiduciary responsibility. In fact, all board members have this fiduciary responsibility, and we'll talk about that in a second. But at a high level, from our experience, we've identified 3 factors that we think are really critical in finding somebody that should sit on an investment committee. So this would be somebody that has kind of the right mix of personal experience. Maybe they've worked in an accounting or finance role in their professional life, or they just have a lot of experience in this area. They feel comfortable working with numbers, talking about investments and doing budgeting and things like that. And since you are working with monetary resources in this position, you want somebody on this committee to obviously be trustworthy. You probably don't hire the person with a criminal record, I would recommend, but somebody that has the expertise, that's trustworthy, and then finally, someone that's really committed to being there and that has staying power. And that sounds simple, but it's tough to find somebody that have all these 3 qualities. I think a lot of people join boards with really good intentions, but then life kind of gets in the way, and it's tough to keep up on this stuff, and it's tough to make a board meeting at 7 p.m. when you want to go home and see your family. And we actually had an unfortunate experience of we met with one of our nonprofits, and I think only 2 out of 6 people on that investment committee made it to the meeting, and the 2 that were there kind of voted to make a change that I don't think the others agreed with. And these were people that kind of may have lacked the professional experience bucket here. So it kind of created some conflict among the other board members, but at the same time, they didn't show up to the meeting. So it was a tough situation. It just goes to show that you need the combination of everything to really have a successful investment committee. Typically, we see investment committees meet about quarterly on average. And so we're an investment manager that we meet with a lot of the nonprofits we manage money for, typically twice a year. Some like to do it 4 times a year. That can be a little bit overkill sometimes because not enough things change in 3 months most of the time, unless COVID breaks out, but hopefully the worst is behind us there. But typically 2 to 4 times a year is a good cadence for meetings here, we believe. And then with respect to fiduciary duty, it requires an ongoing level of due diligence. If you do kind of decide to hire an investment consultant, investment manager, or a broker, anything like that to kind of help with your investments, there's a really great resource on finra.org. It's called FINRA Broker Check, and you just want to make sure that anyone that you select, hasn't spent time in prison or anything like that. Obviously, you want them to have a good professional experience and be trustworthy. But beyond that, kind of the fiduciary duties include ongoing monitoring of the portfolio. And this you don't have to understand every investment in the portfolio, but you just need to make an effort to kind of understand the high-level strategy. And we talked earlier about comparing performance against a benchmark. If you select a benchmark and there is a lot of dispersion between your portfolio results and the benchmark, you just want to understand why that is. And so it's really just asking a lot of questions, and then are the answers reasonable to you? Any fees charged in the portfolio, you just want to kind of double check, make sure that they're calculated correctly. It helps to have kind of accounting people involved here when you're going through pages of fine print and account statements and things like that. And then again, just understanding the strategy, the practices around trading, portfolio turnover, any sort of proxy voting and things like that. And then certainly anytime there's complaints or requests related to the portfolio, you want to really be on top of it and respond in a prompt manner. So this is really just the high-level duties, and again, it gets at the main principle that you're acting on behalf of the best interest of the organization. So you really just want to be kind of checking off all the boxes here. All right, and so our final topic would be ESG investing. And so this has really been an explosive field, especially in the nonprofit world. And so just kind of starting at a high level, ESG stands for environmental, social, and governance. It can really be boiled down to investing with what you consider a sense of morality. So just quick examples, environmental factors would be perhaps you want to avoid companies that emit lots of greenhouse gas emissions. From a social perspective, maybe you want to invest in companies that have really diverse boards of directors in terms of gender and race. Governance, you probably want a board of directors that are all independent. You don't want it to be the CEO of the company, his brother's friend, his cousin. You want kind of that diversity and independence. And you probably want them to have rotating board terms as well so that you don't get people entrenched there. So those are just kind of high-level examples. At the end of the day, these are non-financial factors that kind of go into how you invest your organization's money. And it's important, but the point on this slide here is it's tough to evaluate these strategies, and I'll tell you why. First of all, it's a new field. There's a lot of money chasing ESG investing right now, and there's not a lot of standardization in the industry. And so just as an example, like at our firm, we use Bloomberg as a research tool. I can go in and I can screen for different ESG factors. When I kind of just apply no screens and look at the total list, there's over 2,600 factors there. It's incredible the level of detail that they have. So it just goes to show how tough it is to really evaluate things. And like corporate boards across America and across the world, they see this trend too, and so they're really trying to, in some cases, pander to this money flow and really highlight all the ESG positives that their company is undertaking. Sometimes it's more superficial, sometimes it's not. But at the end of the day, it makes it a little bit hard to evaluate. And like I said, there needs to be some more standardization here in this industry. And so when it comes to kind of ESG investments themselves, there's a lot of different ways to do it. A lot of the big kind of mutual fund houses like a Vanguard, a State Street, Fidelity, they're all putting out products that kind of align with ESG missions. In terms of thinking about an ESG framework, maybe for your portfolio, I would be asking the questions, what's your organization's mission? What do you guys do? What are you trying to change about the world? And so are there any industries that kind of counteract that mission? And so should they be off limits? And again, you would specify this in an investment policy statement that certain industries maybe you don't want included in the portfolio. And I would try to not be too broad. I would try to be more narrow and focused, because I think, like I said, there's so many data points here that you can kind of just go data crazy, trying to do a little bit of everything. So if you're focused on if you're a land trust, focus on environmental outcomes, focus on environmental factors. If you're more geared towards social change, maybe you focus more on kind of the diversity and senior management on boards of directors. So things like that, I would say don't try to do it all, because at the end of the day, what you're doing with a portfolio is you're trying to achieve the financial objectives of your organization. And if you try to apply too many ESG concepts, maybe your portfolio becomes a little bit less diversified. So maybe it can kind of water down those financial objectives what you don't want to do. I mean, you want the best of both worlds. And so finally, you would also ask, how do you monitor these ESG things? I know, like I was saying in Bloomberg, there's 2,600 variables. It's good and bad. It's bad because it's kind of just a headache, but it's good because we can pull really specific data, and we can kind of put different portfolios, in this ESG model to get scores on environmental, social, governance factors, and you can kind of compare it to your benchmark to make sure that you're kind of achieving what you want to achieve. So there's a lot that you can do, but again, I guess the main takeaway here would be, don't be too broad. Make sure that your portfolio's mission kind of aligns with your personal ESG mission related to your nonprofit.
I had a question here about those ESG-based mutual funds. Are those for different sectors or different industries? How did they usually qualify those?
Yeah, typically, what I've seen, it's broadly diversified, and so I mean, on a high level, a mutual fund might invest in large cap growth, large cap value companies. A lot of the ESG funds I've seen, they're diversified across different industries, so there's no kind of sector concentrations or anything like that. So they're pretty broad level. But I imagine that so I don't know a ton about this area, but I'm speculating a little bit. There's so many products out there. I'm sure that there are kind of ESG funds related to specific sectors. So if you wanted to get really detailed, I'm sure you could find an investment vehicle that could get you there. But again, I would really be reading the fine print with a lot of these, because it's tough. Everybody defines ESG principles differently. So if you do invest in this area, you'd want to take a look at the prospectus and kind of get commentary from the fund managers about what their philosophies are. Because again, it's tough to find uniform definitions for very subjective concepts. Yeah, and so here's just kind of a quick example for fun. Of those 2,600 different variables I mentioned, so I screened down to environmental, so E in the ESG, and then climate exposure objectives or variables, sorry. And so I came up with 52 of them in this Bloomberg screen. So it just goes to show that you can really get specific with this stuff. And again, it's good and bad. It's good because you can really drill down and accomplish your objectives and see things very, very clearly using some of this data. But to do it in a way that you don't get lost in the data is a little bit difficult. Okay, so this next slide gets on this concept that's relatively new that's called greenwashing. And what this is essentially not pretending, but saying that you're on board with ESG principles while it may only really be at a superficial level when they're not really core values of your company. Essentially, I mean, corporate America realizes that there's a lot of money flowing towards ESG type investments. And so they're really trying to tailor, their investor presentations and prospectuses to some ESG principles. And it's good in a sense because now when you read through their SEC filings, there's a lot of disclosures related to ESG principles. So they do give some more transparency to their investors there. But I'm going to run through this example and show why it's not always a good thing. So recently there was an oil and gas drilling company, and they did a debt issuance. So they raised some money, and what I noticed is that this company, I mean, they had a really strong balance sheet, really great cash flow. So by all standards, they should have raised a really low cost of debt. I mean, interest rates, everybody knows, are so low right now. And this is true for corporate America too. And they might borrow money and issue a corporate bond, and they're only paying maybe 2 or 3% interest on that. So this company was trying to raise money, but they were paying something like 8, 9, 10%. And And it almost didn't make sense because they had the financial metrics that should correspond with a lot lower cost of debt. But essentially what happened is that all the potential investors out there that want to invest in corporate America's debt, wanted to avoid this one. They didn't want to buy debt of a company that they felt was doing something that would adversely affect the environment. And so because of that, it dropped off the demand for this company's debt, and it made the debt a lot more expensive, meaning they had to pay their investor base a lot more interest to get people to buy their debt. So the point here is that ESG investing, it does work. Oh, but the main point here is that in all their investor material, they would highlight their ESG principles, and they really tried to emphasize this. But at the end of the day, I mean, there's no secret about what they're doing, and there's no secret that it's not good for the environment. But again, they're just trying to jump on this ESG bandwagon, hoping that it would score them some points with investors. But luckily in this case, investors saw right through that. And that leads me to the next point, is that ESG investing does work. Because by any other metric, this company should have been able to raise low-cost debt, but they didn't because their ESG principles didn't align with what investors wanted. So in essence, it made them pay more for their debt, so it makes it tougher for their operations to be profitable. And I think the same is true for their whole industry. So this ESG influence is having an impact in making it harder for companies that may pollute the environment to kind of be profitable. So that's ultimately a good thing. And this is just one example, but I think that there's a lot of them that are out there. And I would just conclude by saying that be very skeptical when companies talk about their commitment to ESG factors. I think that you really need to read the fine print and really understand what they mean when they talk about ESG factors, because in the case of this oil and drilling company, investors saw right through it, but sometimes it's not that easy to kind of spot somebody that may be claiming one thing while they're doing the next.
So
that's it for this example.
So I'm assuming that the advisor that you're working with would be able to do that research and find out if this really is someone or a company that would align with the values that you have.
Right. Yeah. I mean, if it was like an ESG mutual fund, I assume that they would not invest in something like this. Or if it's just kind of a portfolio of individual investments, not in a fund structure, but more individual securities. And I imagine that whoever's managing that portfolio would be doing the due diligence on all those individual investments. And yeah, if there's an ESG mandate in the portfolio, you'd steer clear of this area.
All right.
So I guess that's everything we have today. I know this is a little brief, but again, we really just hope that you got something out of this. We tried to provide just a high-level overview in a couple different areas, or 3 different areas. So just to recap here, a well thought out investment policy statement, again, I think is an essential tool for any sort of organization with an investment portfolio, because it's going to align expectations on all sides of the table. And if tomorrow your investment manager gets hit by a bus, at least you have a document that you can go to the next person and say, hey, this is our plan. Can you please implement this? And I think working with someone to take a consultative approach with this is definitely important. And when it comes to kind of building an investment committee, we've talked about those 3 key areas. You want someone with the right experience, who's trustworthy and committed. Again, I think that's a tough combination to find, but if you can, I think that's a real recipe for success with an investment committee. And then finally, with ESG investing, right now I do feel a little bit like it's the Wild West out there in terms of all the new products being offered and all the capital kind of chasing this area. But I think it is having an impact. and it is kind of shaping the corporate landscape. So I ultimately think it's a good thing. I would just be looking for some of the regulatory bodies and some of the big mutual fund houses out there to kind of create more standardization and uniformity in the industry so that people can really know what they're investing in, and we can kind of objectively define some of these concepts that may be tough, that might be very subjective and tough to define. So with that, I believe that's it. I hope that you got a lot out of it again, and happy to answer any more questions.
All right, we do have some questions here. The question that, I'm sorry, let me pop up the right slide here. Is there a minimum for a nonprofit to start an investment portfolio?
Yeah, there's no minimum. I mean, you can have a nonprofit account set up at any number of investment brokers like a Schwab or Fidelity, and kind of just start managing it yourself. And I think if you want to work with an investment professional, there's a lot of folks that specialize, I think, in nonprofit investments, and those folks would likely have minimums. There's some firms out there that are just like very institutional, so they would only work with portfolios of say 5 million or more. But I mean, there's nothing preventing anybody with a nonprofit from starting an investment account. I would say that the minimums will only come in likely, and they'll vary firm to firm if you want to hire some sort of investment manager to kind of take over the portfolio management for you.
So from what I understand, you can start small and build it up to where you could hire an investment manager.
Exactly. Yeah. And some brokers out there, they may do it. They may take it on no matter how small it is if they think that there's going to be growth there in the future. But yeah, there's no kind of official barrier to entry for that.
Very good. All right. Here's another question that we got. How long does it take to put together that investment policy statement, the IPS?
Sure. So the biggest hurdle in putting together the IPS, in my experience, is just the back and forth between board members and investment managers. And a lot of times nonprofits, they may only meet sporadically or once a month or something like that. And so you have to wait till the next meeting to bring up the issues. But in terms of actually like doing the work to put it together, I don't think it takes a whole lot, but I think just getting input from all parties, that's kind of the biggest lag in the process. So I don't know, anywhere from a couple weeks to a couple months, kind of depending on how quickly everybody kind of communicates with each other, I would say is a reasonable time frame.
All right, here's another question. This is a very good one, I think. Say you have a personal financial advisor who handles your portfolio. Would that be a good person to go to for your nonprofit?
I think that would definitely be a candidate. I would want somebody that would have experience working with nonprofits, so they can understand any kind of nonprofit related issues that you may deal with. I think I mentioned this earlier, but many 501c3s have to distribute 5% of their portfolio every year to maintain that status. So for something like that, you'd always want to have a little bit of cash in the portfolio ready to be distributed. And so you'd want somebody that's familiar with kind of making those consistent distributions, and that has experience kind of managing balanced portfolios. So I would say there's always an equity and fixed income component in the portfolio. But that certainly is a candidate. Kind of depends specifically on their experience, I would say.
So besides saying, excuse me, do you have experience working with nonprofits? Are there specific questions that you could ask that would get, because they may have experience working with 2 or 3 nonprofits, and that might not be someone you want to choose?
Yeah, I mean, I would certainly be asking questions, about their investment strategy, investment philosophy, ask if they've ever written an investment policy statement or if they would feel comfortable kind of reviewing, if you have one in place, if they could review it for you. So it would kind of just be general strategy questions like that. And again, I made that reference to FINRA broker check. I mean, I would want to kind of do your due diligence and check out their background. Because again, when it comes to a nonprofit, you need to be acting in the best interest of the nonprofit. And so that requires kind of some standard due diligence there. And then, I mean, the fees are a big one. I mean, there can be, I think, there's more work on the investment manager side for nonprofits because you need to abide by the IPS. There may be restrictions in the portfolio that cause your other accounts to deviate from the specific nonprofit account. So that's kind of added attention and management. So I would just kind of want to understand their process around that as well.
And we have some good questions about ESG investing. And so I want to hit these and then we'll have to finish up here. But this has been really informative. I want to thank you, Ethan. Someone asked, you said that there needs to be standardization in the ESG space. Who or what agency would drive that?
Yeah, sure. So right now, so I'm a CFA charter holder. So that stands for Chartered Financial Analyst. And so there's a CFA society that's held in pretty high regard in the financial industry. And right now, the CFA society in the United Kingdom is actually putting together a program to start to certify CFA charter holders in ESG investing. And so I'm sure that they're taking a look at all the available literature out there. They're compiling it, putting together a curriculum. And so I think the CFA would be a body to look to kind of be a leader in the industry to kind of start to create some of that standardization and that uniformity. It's certainly going to take time, and it needs to kind of be widely accepted and put into practice and before it can be commonplace. But that's who I would be looking to. I'd be looking to the experts, and they're certainly an expert in this area.
All right, and I think maybe you might have already answered this one, but I do want to make sure we get to this question. You said there was extra research required for ESG investing, and does that come with extra fees with your investment manager?
Again, that'll vary investment manager to investment manager. I would say that if you have an investment manager that specializes in ESG investments, there's not going to be any added fee because that's already what they do, and that's what they do for all their clients. But if you're talking to your personal financial advisor who you really like and they manage a few nonprofit accounts, maybe they would tack on an extra fee if ESG is going to be part of your specific portfolio, but it's not something they do on a more general basis. And essentially, if a manager kind of has scale in a certain area, then the fees can be more reasonable. But if it's going to be kind of special niche work, then there likely will be fees tacked onto it.
Very good. Thank you for answering that question there. Well, folks, we have come to the end of our time here today. I want to thank everyone for being here and thank the organizations that have made this possible. Thank you, Ethan, for opening up this world to our viewers. So here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.